Hey everyone, and welcome back to the channel. In today's video, as you can see, we're going to be doing a full stock analysis of the company, the Cheesecake Factory, which is a restaurant chain in the United States. So I'm super excited to jump into this one. And as per usual, we'll start off with a brief business overview of what the company is before diving into our 4 key areas that we should always be focusing on in our stock analysis. That being the business itself, its industry, its competition, that sort of thing. We call this developing our circle of competence, finding out if the business is one that we can thoroughly understand and one that we're going to be able to predict its cash flows in the future. Then we go and have a look at the economic moat, or some kind of long-term competitive advantage that this company may or may not have. We need to assess management in terms of their integrity to shareholders, as well as their skill at making decisions within the business. And of course, at the end, we'll do our intrinsic valuation, where we'll estimate how much cash we can expect to get out of this company over the long term, and therefore how much we should be willing to pay for it. So if you do enjoy the video, make sure you leave a like. It helps me out a ton, and I really appreciate those of you who support the channel by leaving a like and also leaving a comment down below, and of course being my loyal subscribers. But for now, guys, let's jump straight into the analysis. So before we get into those 4 key areas of analysis that we need to look at, let me first just explain what the Cheesecake Factory is as a company. The Cheesecake Factory was the first restaurant in the upscale casual dining segment, which started in 1978. The company currently operates 219 different restaurants in the United States, Puerto Rico, and Canada, and 202 of those are under the Cheesecake Factory brand, and then they have a handful of other brands that they have a couple of restaurants in. They have 14 under Grand Lux Cafe, then they have 2 under another brand, and finally 1 more under another brand. And this company has been renowned for being very good for their employees. So they've consistently been able to make it onto the Fortune Top 100 workplaces to work. And they've also led the way in terms of hiring millennials and also diversifying, having diversity in their employees. And this is definitely something that you want to see initially when looking into a company, because if you have really happy employees, if employees are saying that it's a great place to work, then they will work there longer. There will be less turnover, which is cheaper for companies. And it means that it's likely that their happiness as an employee is going to project onto the customer, especially in a service industry like the restaurant industry, where the happiness, I guess, of the waiters and the staff is going to have a big impact on how satisfied customers are with the service they receive. So now that you know what the Cheesecake Factory is as a business, let's jump into the first area that we need to assess, which I like to call the circle of competence. And this is where we start to develop our understanding of the business and decide whether or not it's a business that's what Warren Buffett would say is within our circle of competence, a business that we can thoroughly understand and one that we're going to be confident in predicting the future cash flows of, so that we can come to an accurate valuation. Because ultimately, the biggest factor that impacts your valuation and your skill as an investor is your ability to understand the underlying business and its industry and accurately project into the future what you're likely to get back. And if you're able to accurately predict what you're going to get back, you can accurately decide how much you want to pay dependent on what kind of return you want to receive. So let's zoom in on one part of the circle of competence analysis, and that being looking at the competition, analyzing the competition of the Cheesecake Factory in the restaurant industry. The restaurant industry is highly competitive, and the Cheesecake Factory competes for customer traffic from other casual dining restaurant chains such as Texas Roadhouse and Buffalo Wild Wings, as well as home delivery services, mobile food services, grocery stores, and meal kits. So as you would expect, the restaurant industry is highly competitive. There is a lot of customers, but there's also a lot of choice. And you're not just competing against big chains, you're also competing against single restaurants, people who have just started a restaurant. You're competing against all of these other things such as delivery services. And there's a huge diversity in the restaurant industry, which means if you're going to capture it as a business, if you're going to capture a large proportion of that industry, you have to have some kind of competitive advantage. Now, I just want to quickly read you an excerpt from the 2018 annual report about what management had to say about this highly competitive industry. Increased competition coupled with an oversupply of restaurants has driven casual dining industry comparable traffic declines in recent years. This backdrop has made it even more challenging to improve customer traffic. We also compete with other restaurants and retail establishments for quality sites and quality staff and managers to operate our restaurants. So management touches on two important things here. The second one, which I'll mention first, is that they not only compete in terms of customers, but they're also competing for locations where to build new restaurants that are going to generate a high return. And they're also competing for managers and staff. But the first thing that they mentioned there was that there's been a decrease in the amount of traffic coming into their stores in the past few years. And this is something that's shaken up the restaurant industry and had its most significant impact between 2015 and 2017. So prior to 2015, a lot of restaurant chains were doing really, really well. They were generating a lot of free cash, and you will see that from around the bottom of the recession up until 2013 to 2015, you will see that a lot of restaurant chains had their stock prices go up massively. And part of the reason for that was because they were generating a lot of cash. And what these restaurant chains then went and did is that they took that free cash and they started building, or they continued to build, a huge amount of restaurants. And this actually led to an oversupply of restaurants in the US during 2015 to 2017. And many will argue that there is still a massive oversupply of restaurants to this day. And what essentially ended up happening was that comparable restaurant sales declined significantly during 2015 and 2017. So comparable sales is essentially a measure that takes into account the traffic, the amount of people coming into those restaurants, and also the check size, how much each of those customers are paying. And the primary driver which sent down comparable sales during 2015 and 2017 for the restaurant industry in general was this decrease in traffic. And the main reason for that is pretty self-explanatory, is because there was an oversupply of restaurants. So those customers, that customer base, which in the restaurant industry really doesn't grow or shrink over time too much, it's pretty steady. That customer base was spread over more restaurants, and the result of that was there was a decrease in comparable sales for many restaurants. So an example like this is exactly why you need to be aware of the unique factors that are impacting the industries and the businesses that you're investing in. You can't just go ahead and invest in 20 businesses because they have big brand names. You need to know what's going on within these businesses. Because if you understand the restaurant industry, then you may have a great understanding, or you may have a better understanding than the average investor, and you may be able to work out whether or not that oversupply of restaurants is a short-term or a long-term problem. You could think of it as, if you have a restaurant chain that's just in the US, then that's going to be negatively affected by an oversupply of restaurants. But that could be a short-term problem if that restaurant is able to expand globally and grow their sales in that way. And when that oversupply of restaurants slow down because it's not as lucrative anymore, then those businesses will return to seeing positive comparable restaurant sales. So this is why it's so important, and I'm going to stress it so many times throughout this video, it's so important that you understand the unique nuances of each of these businesses that you're investing in, and don't just invest in something understanding the top level. Make sure you dig deeper and understand what actually drives these restaurants and what's happening within the industry. When there's really a lot of positivity, they're going to build a lot of restaurants, and that's going to lead to oversupply, which means the restaurants aren't going to perform as well. So moving on now to our second part of the analysis, which is to look at the economic moat. We need to see if we can identify any kind of unique advantage that this company has over its competitors. Because as I said, the restaurant industry is very, very competitive. So if these restaurant chains are going to survive, they need to have something unique about them that allows them to draw in more customers and retain those customers over an extended period of time. Now, in terms of the restaurant industry, the major advantage that these companies are going to have is that they're going to have a branding moat. Customers are going to recognize the restaurant chain and consistently come back there because they like the food and the service. However, this kind of branding moat is what I would consider narrow. It's one that can be sort of overcome over time, and it can be eroded by changing customer preferences. Now, I spoke about this a lot when I did the Texas Roadhouse analysis, so I'll leave a link to it up there if you want to check that out and hear me explain their branding moat, because it's a very similar situation to the Cheesecake Factory. But let's now jump into the numbers and do our quantitative analysis to see what their numbers look like and whether or not they tell us anything about a competitive advantage that this company may or may not have. Sales growth has been very consistent but extremely slow at somewhere between 3 and 4%. Earnings per share in the past couple of years has been negative, but over the long term has been about 13%. Equity growth has been pretty much flat, and it's actually declining significantly in the past couple of years. And then we have free cash flow, which again has been pretty flat over the long term, but has seen massive increases recently because their free cash flow went down, and now it's returning back up to similar levels to what it was 9 years ago. So from our understanding of the restaurant industry and how a branding moat is one that can be crossed over time, it's not that strong, and looking at their numbers that are pretty weak, we can pretty much conclude that they don't have a wide economic moat, they don't have a powerful competitive advantage. It's possible that they have a narrow moat, some kind of small advantage that's allowing them to still be very successful in this industry. They're one of the best restaurant chains in this industry, but in terms of looking at businesses with a sustainable long-term competitive advantage, the Cheesecake Factory is a company that just does not have one. And for those who don't understand what I'm saying here, I'm saying that because they don't have a competitive advantage, we can't be confident that over the long term, they're going to continue to perform as they have. So this would I would never invest in a company that doesn't have a competitive advantage, because without one, any other company can just come in and do something slightly better than this company, for example, and take all of their customers or take a significant amount of their customers. We need to know that our businesses have some kind of protective layer around them so that we can then be confident in estimating into the future and be confident in investing that we're going to get back at least what we invested in the first place. So that brings us to the third part of our analysis, and that is to assess the management. And the reason why we need to assess management is because management are the people who are making decisions on behalf of our company. Remember, we're shareholders. We own the company. So that means that we have to put a particular group of people called the board of directors or executives, and they will be making decisions about where to put money in order to grow it into more money. And those decisions are going to impact how much money we get back out of this company over the next 10 or more years. And to assess management, we look in 3 areas. The first is we need to assess their integrity. We want to make sure that they're being honest with us and that their interests are aligned with our interests. Then we need to look at their capital investments. How effective are their investments? Are they generating a high return? Because if they're generating a high return on their investments, then we can expect that over the long term, they're going to be able to generate more and more profit for us over the long term. And then the third part is to look at debt, to make sure that they're not taking on an overwhelmingly amount of debt. And of course, if they have too much debt, that leaves us with the risk of losing our entire investment, of the company going bankrupt. And we can easily avoid losing all of our money by just investing in companies that of course have a competitive advantage and a management that has integrity and is good at investing, but one that doesn't have much debt at all, so that risk of going bankrupt is really non-existent. And in today's analysis, we're going to zoom in on that debt and have a look at how management for the Cheesecake Factory has managed their debt over the past couple years. So as of January 1st, 2019, which is our latest data for the Cheesecake Factory, they had current assets of $195 million and current liabilities of $417 million, which gives them a current ratio of 0.5. Now, this is far below our minimum. We're looking for a current ratio that's above 2. However, 172 million of those liabilities is unclaimed gift cards. So if we exclude that out, then their current ratio is much better. So in terms of short-term assets and short-term debt obligations, looking at the current ratio, their current ratio looks bad, but if you take out those gift cards, then it's not too bad. It's okay. It's not outstanding. It doesn't give me overwhelming confidence, but it's not the worst I've ever seen. So next, let's have a look at their total debt compared to their total equity within the company. Total liabilities as of January 1st, 2019 was $743 million, and they had equity of $571 million, which gives them a debt to equity ratio of 1.3. Again, well above our maximum. This is a maximum we're looking for. So we're looking for below 0.5. So looking at these two ratios, we can look at their short-term and their long-term debt compared to what they can use to pay it off. And the Cheesecake Factory does have higher than average debt, higher than what I'm looking for in general. Now that doesn't mean it's a bad investment, but it does increase the chance that we could lose the entire investment. You've got to be aware that if a company takes on debt, they need to pay it back in the future. They're borrowing from their future self. So their ability to make those future payments could impact whether or not you have a business in 10 years time or not. And for me personally, I would just stay away. I would personally just like to invest in companies that don't have much debt at all and can easily use their cash or their income, their cash flows to pay off their debt really, really quickly. And finally, of course, that brings us to doing an intrinsic valuation, calculating exactly how much cash we can expect to get back from this company, and therefore how much we should be willing to pay for it. Now, the analysis up until this point has shown us that we may be able to understand it. Restaurant industry is a pretty simple business model. However, they don't have a distinct competitive advantage that I can identify. You might have a different opinion. This is not a recommendation. This is just my personal opinion and using an example to show you how I do my analysis. But using my analysis, I would conclude that this company doesn't have a competitive advantage and that their management hasn't done an outstanding job at keeping their debt to low levels. So up until this point, I don't even have a lot of confidence in this company in projecting their cash flows into the future. So this intrinsic value is contingent on all of that. It's definitely not as clean of an intrinsic value as if we were doing one of a company that had a huge advantage over other companies and had no debt and had a high return on capital and ticked all of the boxes that we've looked at so far for the business. So just keep that in mind when we're looking at this, that even though we're being conservative, we still really shouldn't have any confidence that they can achieve this because they just haven't been able to show us that they are a consistently great business. For this intrinsic value, I did a discounted cash flow, which is where we estimate how much cash we can expect to get out of this company over the next 10 years, and a terminal value, and then we discount that back to the present day to calculate how much we should be willing to pay for it. If you're not aware already, this is a new part of my stock analysis spreadsheet, which you can get for free via the link in the description below. So if you want to be able to do discounted cash flows really easily, then go ahead and download my free spreadsheet. But essentially here I've entered in a couple of different numbers. You can see under year 0 actually, I've got 247, which represents their 247 million in owner's earnings. That's an estimate that I've made of how much cash we could have expected to get out of this company in 2018. And then in the growth tabs, we've got a number of growth rates that they can grow that cash flow into the future. And then we're using a risk-free rate of 3% as our discount rate for intrinsic value. And under the required rate of return, you can see where we're targeting a 22% return, which is a 15% return plus a 50% margin of safety. And using that, we can see that under Model 1, we get an intrinsic value of $3.4 billion for the whole company and a buy price of $1.25 billion for the whole company. Under Model 2, we get $4.5 billion for the whole company and $1.4 billion as a buy price. Then we've got 5.3 billion intrinsic value, 1.6 billion buy price, and then under the last model, if they can grow at 6% per year, which is a big assumption to make for a company like this, but nevertheless, that would give us an intrinsic value of just over $6 billion for the whole company and a buy price of 1.7 billion. So those were some of the key highlights from my analysis of the Cheesecake Factory that I've been doing over the past few weeks. If you want access to the full analysis, the full report, written report, and the full 60-minute analysis presentation, then you may consider becoming a member of the Learn by Example platform and community. Members get access to new stock analysis reports and 60-minute presentations every 14 days to help you learn to consistently find low-risk, high-return investments in your own research, as well as our private Facebook community where you can participate in Q&A live streams, discussions, and more. The Cheesecake Factory was the latest company that I analyzed in the group, and essentially you get access to my full analysis report and a presentation where I go through and explain my rationale behind things that I've included in the report. And this just allows you to apply the process to any stock that you're personally looking at. And this process is what has allowed me to consistently find those low risk, high return investments that are going to propel your portfolio over the long term. But for now, guys, I hope you enjoyed this one. And if you did, of course, let me know your thoughts down in the comment section below. But for now, guys, I'll see you in the next one.